All right, we are going to go through the new tax law around cash value life insurance and what we can expect as a change in the industry, and really how it will impact whole life insurance policies that are designed for maximum cash value. What's the difference? That's what we want to know. What I'll add, the date we are shooting this video, January 2021, we do not have any information from insurance carriers and how they are responding to this change. We've got some rumors, but nothing in writing at this point in time. Frankly, this is a big change and it is going to take them some time to, one, reprice their products, rewrite their products, but then also test them and make sure everything is set up properly. So it's going to take some time before we see products actually offered that comply with this new change. So the big question, what is going to change? The first thing is the MEC limit. The same death benefit on a life insurance policy will obtain me a greater MEC space than it does today based off the current laws with this new law. We're going to go through this with an example here in a second. Some other changes we can expect. Product pricing. If I'm buying a policy for a pure death benefit, that death benefit will likely carry a higher base premium. They'll be a bit more expensive if I'm purchasing policies again for pure death benefit. If cash accumulation, maximizing cash value is my goal, you won't see much of a difference, but we're going to get into that in more detail as well. The guaranteed rate, we may or may not see changes here. Again, we're hearing different things from insurance companies. How this change, Section 7702, impacts the industry, it has to do with the reserve requirements that insurance companies must have. So how that impacts the actual whole life insurance product, where I have a guaranteed rate of 4%, can definitely be impacted. But rather than state guaranteed rates are definitely going to be lower, definitely going to be the same, because different companies are stating different things in our experience from talking to them, we may see a change. Let's get back to the MEC limit and the fun part. So, same death benefit obtains me a higher MEC limit. So, as an example, if I have a 50-year-old male, based off of the current MEC laws, a $2 million death benefit obtains you almost a clean $100,000 MEC limit. It's almost exact. So with this new update, what's going to happen is if I take out a policy with the same $2 million death benefit, I may see a MEC limit of, call it $160,000. Could be higher or lower than that. Point being, $2 million today obtains me $100,000 in MEC space. That's how much I have the ability to pay into a policy on any given year. Whereas $2 million tomorrow, when this new rule actually takes effect and insurance companies offer products based on the new tax code, I may have $160,000 of MEC space. So I can pay more money into a cash value life insurance policy. I'll get into exactly how that is relevant as well. What may not be impacted here? Policy design. So insurance companies have premium and PUA limits. We talk about this frequently. My money can go toward the base premium or the PUA component. And really, if I drive more funds towards the paid up additions rider, that puts me in a better position where I see more cash value from start to finish. How do I maximize the cash value of a life insurance policy? That's it, that PUA rider. So with the product design, companies have an appetite, call it, of how much money they're willing to accept in PUAs above and beyond their base premium. So with the new tax change, will that impact the policy design at all? It's possible, but right now, just from talking to them, those limits could very well stay the same. So how is this going to come into play? Where it helps, all companies have death benefit limitations, meaning if I make $100,000 per year and I'm 30 years old, I may qualify for 30 times my income in life insurance. So if I earn $100,000, I can qualify for 30 times my income. That's $3 million in total life insurance. If I'm 50, the income multiplier might only be 20x or 25, depends on the insurance carrier. Point being here, here's where it can help, is if I'm a 50-year-old male and I am approved for a maximum death benefit of $2 million, I now have a higher cap. I should state higher MEC limit. Going back to this example, today, for a 50-year-old male, if I qualify for a maximum death benefit of $2 million, that means I have the ability to pay up to $100,000 per year. I can easily commit to $10,000, but my cap would be $100,000. Whereas the new change, I've got the ability to pay more. So now with the new MEC law, if the company says, okay, the maximum death benefit you can still be approved for will be $2 million, Mr. 50-year-old male, well then, I can now pay up to $160,000 per year into a policy. So if I'm an individual that I have a lot of cash on hand, whether it's from a real estate sale, an inheritance, whatever it might be, but I'm capped out as far as the total death benefit that I can obtain, this is where the law can particularly help me. It can open up the window room, give me more MEC space, so now I can funnel more money into a cash value life insurance policy. Now, of course, I'm very interested, as always, to see what the guaranteed values look like and such. This way we can measure the pros and cons. In my mind, there's always give and take with any type of relationship. When we look at changes in the tax law, the same thing happened when the new mortality update came earlier 2020, January 2020, and had to go into force. When that law, or I should say when that mortality update occurred, the same death benefit obtained you less MEC space than what the prior mortality tables did. So we had to make a pivot there, yet the guaranteed values were a bit stronger. So that's the kind of stuff we want to look at as we see more information come about. Now, let's look at an example here of a 50-year-old male to give some visuals, to put it into perspective more. So we've got a 50-year-old male. Based off the current laws, to kind of match up with what we were just talking about, here we see a $2 million death benefit, which gives him a $100,000 MEC limit, $100,000 per year for 5 years, breaking even between years 3 and 4. Now, if he wanted the ability to pay $160,000 per year based on today's MEC law, we'd have to raise that death benefit because, again, what has a direct relationship to my MEC limit with the policy? Age and total death benefit. So to be able to pay in $160,000 today, I need to have a $3.2 million death benefit, which I may or may not qualify for based off the company's income multiplier. Whereas with the new rule that's coming out, if $2 million obtains me $160,000 in MEC space, what we've seen thus far is that it might obtain 60% more MEC space than what it does today, the new tax law. What I would see is a similar death benefit to this, but then comparable cash values to this, because I've got the ability to pay in more, if that makes sense. I know this can be a little difficult to follow, because this is conceptual here. What we also ran with a different company is this. So here you see a policy on the left with a 100K MEC limit and a 1090 split. 100K going in per year. There's my cash value. Death benefit, just about $2 million, which gives him what? A $100,000 MEC limit. That's exactly what we did. Here's a policy, identical death benefit, but we directed $160,000 per year into the policy, which MEC'd out. This is a modified endowment contract. The purpose of showing this is based off the new laws. This is a 1090 split and has a $16,000 base premium because the insurance company limitations may or may not change as far as how low they allow us to go with the minimum base premium. Maybe lower, perhaps a portion of that base premium comes back to cash value. There's been talk as far as restructuring the compensation as well. Again, this is all information that is speculation right now, not concrete. But point being, what we might see is something like this that is no longer a MEC, same death benefit, but comparable cash values. And this is based off of the company's present dividend rate, or non-guarantees, not the guarantees. That's the big thing. Again, I know I mentioned this already, but the guarantees is what I am most interested in seeing. The additional MEC space per death benefit, per the same amount of face amount, will help. We've worked with individuals that had a large lump sum of money. Maybe they received it via an inheritance. They wanted to pay it into a policy, but they were capped out based on the total amount of life insurance they could obtain, which only got them so much MEC space, and they couldn't get the money in. A recent example is someone wanted the ability to pay in $75,000 per year. However, the maximum amount of life insurance he could obtain was a little over $300,000. This was an older individual, and the MEC limit it obtained him was right around $35K. So he's got a big pile of money. He says, I want the ability to pay in $75K per year, or that's how much I want to pay in for the next 5 years. But the insurance company said, no, the maximum death benefit in all circumstances that he can receive is $300K, which gives him a $35,000 MEC limit. So where this new law can help is if he is still capped out at that same $300K death benefit, but now has a $70,000 or $75,000 MEC limit, he's got the ability to pay more money in. So that's the potential advantage there. So know that this is a lot of information, and it is speculation at this point in time because we don't have concrete information, but I promise as it becomes available, we will be making it public. Hope this helps. Reach out with any questions. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.